Yes, good evening, good afternoon, viewers. I welcome you to this debrief for paper 7 of CPA, where we are going to run through the core areas of the paper, specifically as we prepare our candidates to sit for their exams in December. This section for today will provide insights into how to deal with the questions that require candidates to apply accounting standards. As you are aware, financial reporting is one of the core papers for the accountancy qualification. I believe by the end of this session, all of us would have appreciated the relevance of the subject, that is financial reporting. And I hope the session will close gaps, competency gaps that members had or no when it comes to accounting standards. So I welcome you to this session, and I hope it will be a fruitful session. In our session for today, I want us to run through IS1. IS1 is preparation and presentation of financial statements. As you are aware, that paper 7 has two sections, section A and section B. Section A is 40 marks. And over time, this section A has been examined from either IS1 or from group accounting. At times, the examiner can examine section A from IS7. Another person would argue that IS7 is itself part of IS1, which is also valid. So, colleagues, I welcome you to this session. I hope it will add value to you. So, we are going to analyze question 1, which question 1, what is required of us is to advise management on the accounting treatment of transactions in notes 1 to 7, clearly showing the relevant reporting standards and the journal entries required for each transaction. The question requires us to advise. Questions that require you to advise require you to do the following. 1, quote the relevant standard. What standard is relevant for that particular transaction they're talking about? So you quote the standard, you do the computations, and then you pass the journal entries. In reporting, we can advise by passing journal entries. Advising does not necessarily mean that you advise theoretically. When you say debit this and credit this, there you have advising at this level. The same question wants us to prepare the following statements: profit or loss and other comprehensive income, as well as the statement of financial position. And then we shall also look at, we need to comment on the financial performance and the position of this company using these ratios. So normally in CPA, this is how section A can be set. You advise on accounting treatment, you prepare financial statements, and also you comment on performance and position using ratios. This has been the common approach to setting question 1. So I want us to run through this question. I hope by the end of the session, people would have picked something important. So we shall go straight away to the case study, which says that MICAS was established several years ago and prepares financial statements to 31st December each year. And the following information has been extracted from the company's trial balance as at 31st of December 2023. So they have given us a trial balance for this company. Additional information is there from note 1 to note number 8. We can start by answering part A, which requires us to advise on accounting treatment of notes 1 to note 7. So for each of the notes 1 to 7, we are going to provide advice. Okay? We go straight to the expected approach. Part A. Part A, they want us to advise on accounting treatment. Accounting treatment. We shall start with note 1. Note 1. What is note 1 about? When you look at that note 1 there, it says included in MOL's revenue is 250 million of goods sold by MOL to a foreign customer. This was on 15th of December 2023. The goods were sold before the end of the year. They were sold under sale or return basis, implying that the terms of the sale included an option for the customers to return the goods. The customer has the option to return the goods not later than 1 month from the date of sale. Remember, the sale was on 15th. So they have an option to return the goods between 15th of December 2023 and 15th of January 2024. They have that 1 month option. Okay? Yet we are reporting on 31st of December 2023. So by the time we prepare our financial statements, the option for the customers to return the goods is still there. They still have that option because that option is expiring on 15th January 2024. Okay? We can start with this. How do you deal with that? You sell goods, but with an option for the customers to return those goods. So we can comfortably say that note number 1 is about revenue. Note number 1 is about revenue. We can have our revenue. We specify the currency, that our currency is shillings, and whatever we have here is in what? Millions of shillings. Under revenue, we start with sale with return option. Sale with return option. The examiner said that we sold goods. The sales were worth 250. Were worth 250 million. Okay? But the customers have an option to return these goods. And the option to return the goods will expire. Will expire on 15th of January 2024. But we are preparing our financial statements as at 31st of December 2023, implying that by the time we prepare the financial statements, that option is still there. The option is still valid. They can still return these goods. Despite the existence of that option, the accountant went ahead and included 250 million in revenue. The question is, did this 250 million qualify as revenue by December? From a layman's point of view, the answer would be yes, because there was a sale. Therefore, because there was a sale, there was revenue. But because there is an option to return these goods, this sale is still contingent. And therefore, because customers can still return these goods, we have to derecognize this sale. Okay? because you have to test it through IFRS 15. What does IFRS 15 say? IFRS 15 is revenue from contracts with customers. You recognize revenue upon satisfaction of the performance obligation. The condition to return the goods has not yet expired. Therefore, in that case, the performance obligation has not been fully complied with. So, because we are advising, this is how we approach the question. We say that the transaction should be accounted for using IFRS 15. You put dash and say that standard is called revenue from contracts with the customers. As below. Level 2, this is level 2. Quote the standard, compute past journal entries. You have quoted the standard that the transaction should be accounted for using IFRS 15 revenue as below. Okay, then I continue. I say that by 31st December 2023, the return option was still valid. Hence, the 250 million should be recognized as deferred revenue. Because by 31st December, the customers could still return these goods. Because that option was still valid, we cannot recognize 250 million as revenue. Instead, we should defer it. How do we defer revenue? You come here and debit. Remember, the accountant recognized this 250 million as revenue. Therefore, I reverse it from revenue. So I debit revenue by 250 million. Remember, we are holding our 6 zeros on top. And then we credit deferred revenue. We credit deferred revenue. That is the first note. Yes, I agree, we sold goods, but customers could still return them. That means that revenue is, as of now, it is contingent revenue. It is contingent to customers returning or not returning the goods. So for now, you defer that revenue until 15th of January, when the return option expires. If it expires when customers have not returned the goods, then we shall report it as revenue. We continue with the note. The note continues that, in addition, Muru's revenue includes 300 million of goods sold to Zimbe on 1st of January 2023. So we have goods sold at the start of the year worth 300 million. The terms of the sale require Mur, remember we are Mur, to provide ongoing after-sales service for 3 years at a cost of 16 million per annum, starting immediately after sale. Normally, Mur charges a markup of 25% on such servicing work, and the selling price for similar goods without servicing is 350 million. Colleagues, when you look at this second part of the question, it is speaking to what we call combined revenue. Combined revenue is revenue arising from 2 transactions happening at the same time. You have a sale of goods and a provision of services. We sold goods and you're going to provide servicing. So the servicing that you're providing is incidental to us, to the sale of goods. When you combine those two transactions, we are charging 300. Yet the standalone prices for those transactions would be 16 million and 360. Now, how would we deal with such a transaction where you sell goods but also provide servicing? This is a common transaction in our market. This is how we deal with it. So you come here and say you have a combined transaction, combined sale. You have a combined sale. Again, you quote the standard that the transaction should be accounted for using IFRS 15 as below. Because already up there, you have defined what IFRS 15 is all about. So you don't have to rewrite the name of the standard. The transaction should be accounted for using IFRS 15 as below. What is happening in this transaction is you have combined revenue. That combined revenue is worth 300 million. But this combined revenue is as a result of two things. It is as a result of sale of goods and also as a result of the after-sales services. You're going to provide after-sales servicing. That when you add these two, you charge the 300 million. If you are faced with such a transaction, this is how you handle it. You ask yourself that what is the standalone price? You start by calculating the standalone prices. You split these transactions and calculate the standalone prices. If I'm dealing with the sale of goods only, how much would I charge? It is what the examiner told us here. Okay, if I remove these things here. The examiner said that the normal selling price for similar goods without servicing would be 360. So if I had sold goods without servicing, their standalone price would have been 360. So I come here and I put 360. That is the standalone price for goods. Then the standalone price for servicing, how much is it? Again, I go back to the question. The examiner said from here that the terms of the sale require MUL to provide ongoing after-sale services for 3 years per annum. MUL normally charges a markup of 25%. You see, I am providing servicing at a cost of 16 million. That is the cost of the servicing I'm giving every year. But normally, if this was an ordinary transaction, I would charge 25% as profit for servicing work. That means that the selling price for servicing equals cost plus profit. The cost of servicing per year is 16 million plus profit. And they said, I normally charge profit of 25%. So you get 25% of 16. What does this give me? 16 plus 25%, which would give me 20. That is 20 per what? Per annum. But I'm going to provide servicing for 3 years. Therefore, for 3 years, my servicing becomes 20 times the 3 years, which gives us 60. So viewers, you can see that if these transactions were priced independently, I would have obtained 360 from selling goods and 60 from servicing. But because they were priced as one transaction, we charged 300. In that case, we now come here and say that the total standalone prices equal to the standalone prices for goods is 360, for servicing it is 60, totaling to 420. That is the total. If I had sold these independently, but because I sold them as one transaction, I charged 300. Therefore, what I do, I have to distribute this 300 amongst the sale of goods and the provision of what? Services. How do we distribute? We come here and say that therefore, revenue from sale of goods will equal to the standalone price for goods over the total of goods and services times the combined revenue. Okay? So you have 360 divided by 420 times the 300, which would give us 257.1. That is for goods only. Then for servicing, the standalone for servicing is 60 over total standalone 420 times the 300, which would give us 60 over 420 times 300, which gives us 42.9. So that when I add here, I come to the 300 that I charged as revenue. Okay? Now, after doing this split, we know that revenue from sale of goods is recognized as revenue immediately because the performance obligation passes immediately. That's what we call passing at a point in time. Yet revenue from servicing, because I'm going to provide servicing for 3 years, the revenue from servicing will be spread over the 3 years. In this current year, I only recognize revenue for 1 year. Okay? That means, so after calculating the servicing revenue here, it therefore means that the servicing revenue each year, equals 42.9 divided by the 3 years. So 42.9 divided by 3, which gives us 14.3. That is servicing revenue each year. But remember, the accountant took the whole 300. What the accountant should have taken is revenue from sale of goods, which is 257.1, plus revenue from servicing for only 1 year, which is 14.3. So colleagues, I'm saying that the revenue, the correct revenue for this year should have been the revenue from sale of goods, which is 257.1, plus the servicing revenue for only 1 year. So plus 257.1, and this should have been 271.4. That should have been the correct revenue for this year. But what did the accountant do? The accountant recognized revenue to the tune of how much? 300 million. That means the accountant overstated this revenue. By how much? By 28.6. That 28.6 is the overstatement of revenue. That 28.6 is revenue that should be for year 2 and year 3. Because in each of those years, you are recognizing 14.3. So this overstatement in revenue should be reversed from revenue. How do we reverse? We debit our revenue with the 28.6 and we defer it. We are not saying that we're not going to earn it. We are going to earn it, but later in future. Therefore, we defer that revenue. So I credit deferred revenue, 28.6. Viewers, there I have recognized and I have advised management. That is note number 1. When we go to note number 2, note number 2 says, recently, Mike has revised its accounting policy to provide for evaluation of property, plant and equipment. Consequently, the company revalued its PPE to 11,400 on 1st January 2023 with the non-depreciable component. Non-depreciable component means land. So the non-depreciable component accounted for 3.4 billion. The estimated remaining useful life of property was also revised to 25 years. We know that when you revalue an asset, you also revise its useful life. You can revise the life upwards, downwards, or you can say there is no need to revise the useful life. However, the property was subsequently revalued to 9.8 at the end of the financial year with the depreciable component. Depreciable component of property is the building. The non-depreciable is the land. So the depreciable component accounted for 65% of the valuation. Despite the subsequent revaluation, the remaining useful life of the property remained unchanged. When we carried out another evaluation at the end of the year, we did not change the useful life. Micas has not accounted for the effects of revaluation. And then lastly, plant and equipment is depreciated at 20% per annum using straight line. Whenever you are handling an exam, you attack from the weakest link. We shall start with this one, plant and equipment. So I come here and we say that this is note number 2. And note 2 is about property, plant, and equipment. Property, plant, and equipment. We can have all our amounts in millions of Ugandan shillings. Okay? That is the note. We said you start by quoting the standard. So you say that the note should be accounted for using IS 16 PPE. IS 16 is called property, plant, and equipment as below. As below. I said attack from the weakest link. We can start by looking at plant and equipment. Plant and equipment. They said the cost of this plant and equipment is equal to what? You look at the trial balance. When I look at my trial balance, I can see plant and equipment at cost, and it's 19,562,500. Okay, so the cost is 19,562.5. Remember, for us, we are holding 6 zeros. That is the cost. And they have told us that we are depreciation expense. We are depreciating a straight line at a rate of 20%. So if you are depreciating a straight line, you get the depreciation rate times the cost of the asset, which is 19,562.5. Straight line implies that you apply the depreciation rate on the original cost. So 0.2 times 19,562.5, which gives us 391,2.5. That is your depreciation expense. After calculating your depreciation, you now pass your journal entries. You debit. Depreciation is an expense. Because it's an expense, we take it to profit or loss account. Okay? Now, normally, the examiner will guide you on where to charge depreciation. Let us run through the question. Is there guidance on where to charge depreciation? From note number 1, number 2, there is no guidance. Number 3, there is no guidance. Number 4, not there. Number 5, not there. Okay. So there is no guidance. Then you have to choose where you want to charge it. We encourage that you charge depreciation to administrative costs. That is best practice. Therefore, we are going to debit our profit or loss. We are debiting profit or loss because depreciation is an expense. So in profit or loss, specifically, we are charging it to admin costs. That is 3,912.5. As I debit the profit or loss, I credit the asset because depreciation being an expense reduces the carrying value of my asset. My asset is called plant and equipment. So I credit it with 3,912.5. There I have advised. Okay? We continue. After plant and equipment, I now go and deal with property. I now go and deal with property. What did the examiner say? You go to the note. The examiner said under property that recently we revised our accounting policy. And on 1st of January 2023, we revalued our property to 11,400. Remember, property is both land and buildings. Land does not depreciate, but buildings do. Therefore, when we are dealing with the property, we have to split land from buildings and account for each separately. We shall come here and say the total cost of property, which you get from the trial balance. If you look at your trial balance, the total cost of your property is here. Property at cost is 10. But of the 10, land is 2.5 billion. Okay? So I'm going to deal with the land first. Okay? We are saying that the cost of this property is given to us as 10,500. Of this cost, land itself is 2.5 billion. It means the balance is the building. How much is balance? 8 billion. That is according to the question. Therefore, I start with the land. Let me start with land. They said land originally costs 2.5 billion. It doesn't depreciate. But I came on 1st January and I revalued my property. When I revalued my property, I got a new value of how much? Of 11.4. Of that 11.4, the non-depreciable component, which is land, was 3.4. So I come here and I say, my land was revalued to 3.4. You compare those two. It originally cost 2.5, revalued to 3.4. That means there was a gain on revaluation of 900. So this is a gain on revaluation. When I have a gain on revaluation, I pass my journal entries. I debit. I'm dealing with the land. So I debit my land with the 900. I credit revaluation reserve. Revaluation reserve. But whatever goes to revaluation reserve starts from other comprehensive income. A revaluation gain is notional income. Revaluation gain does not go through profit or loss. It goes through OCI to be able to end up in revaluation reserve. So I'm debiting land because land, its value has gone up by 900. Then later, the examiner tells me that I came back on 31st of December, 2023. We came back on that date and carried out another evaluation. But before you revalue an asset, you first ask yourself, what is the carrying value of that asset? That asset is land on the date of revaluation. Remember, land does not depreciate. Initially, it was 2.5, it went to 3.4. So 3.4 comes here as the carrying value of that asset. When you revalue an asset, that revalued amount becomes its carrying value. So when the carrying value of my land was 3.4, it was revalued. It was revalued to how much? You look at the note. The note says, on 31st December 2023, the property was revalued to 9,800, but with the depreciable component accounting for 65. The total value is 9,800 for the whole property, which is land and buildings. Of that value, land is 65. Sorry, building is 65. That means land is 35, the non-depreciable. So it means the revalued amount was 35% of the 980. What does this give us? 0.35 times 980, which is 3,430. That is the revalued amount for land. Then I compare these two. I can see the revalued amount is higher by 30. This is another gain on revaluation. Again, I pass my journal entries. I debit. At that point, I debit land with 30, and then I credit revaluation reserve or OCI with 30. I am done with the land. Then we move to buildings. Buildings depreciate. Originally, the examiner said that buildings cost 8 billion. That was the original cost of the buildings. What was the policy on depreciation of buildings? You look at note number 1. They said, go back to the trial balance. Our buildings can be got from here, where there is property. When you get the 10,500 and remove 2.5, you remain with 8 billion as buildings. The buildings had accumulated depreciation. You see it here. At the beginning of the year, the buildings had depreciated by 1.2. Whereas we are putting their property, we know that property is land and the buildings, but land does not depreciate. So whatever depreciation is there on property, it is depreciation for buildings. So at the start of the year, our buildings had accumulated depreciation of 1.2. That means that on 1st of January 2023, okay, the carrying value of our buildings was, to get the carrying value, you get cost minus accumulated depreciation. Our buildings cost 8 billion. And at the start of the year, they had depreciated by 1,200. That means their carrying value was 6,800. On that date, they were revalued. So I compare this with the revalued amount. How much was the revalued amount? You look at the note. From note number 2, the examiner said, I can remove these things here. The examiner said, on 1st January, the property was revalued to 11,400. Remember, property is land and buildings. Of the 1,400, 3,400 was for land. That means the balance was for buildings. So I come here and I say, the revalued amount is 11,400, of which 3,400 is for land. Therefore, how much was for buildings? You see, the revalued amount of the buildings was 8,000. You now compare the revalued amount with the carrying value. The revalued amount is higher by 1,2. Because the revalued amount is higher, it becomes a gain on revaluation. When I have a gain on revaluation, I pass my journal entries. I debit buildings, because I'm now dealing with buildings with 1,2, and then I credit revaluation reserve. Revaluation reserve or other comprehensive income with 1,2. Okay? After passing those journal entries, I now charge new depreciation expense. Colleagues, whenever an asset is revalued, it doesn't mean that it should not be depreciated. After revaluing, you now calculate the new depreciation. The new depreciation expense is calculated using the revalued amount. You get the revalued amount divided by the revised or remaining life. Okay? Our revalued amount for buildings is now 8 billion. Over. After revaluing this asset on 1st of January 2023, we also revised its life to 25 years. Okay? So I'm going to divide this by 25 years. This will give us 8,000 divided by 25, which is 320. That becomes our depreciation per annum. That is our depreciation per annum. Now that I have depreciation as an expense, I pass my journal entries. I debit, depreciation is an expense, it goes to profit or loss. And we have agreed that we should charge this to admin costs, 320. Then I credit the buildings. I am crediting my buildings because depreciation reduces the value of an asset. Okay? Then later, at the end of the year, on 31st of December, 2023, there was another evaluation. But before you revalue an asset, you first ask yourself, what is the carrying value of that asset as at that date? Remember, this asset had a revaluation at the start of the year. So the carrying value will be the previous revalued amount minus the new accumulated depreciation. After revaluing an asset, you forget about the previous depreciation. So the previous revalued amount for this building is 8 billion, the one that we revalued at the start of the year, minus the new depreciation, which is 320. But from the previous revaluation to the current revaluation, it is a difference of 1 year. If it were 2 years, I would multiply this by 2 years. Because you count depreciation from the previous revaluation to date. This is giving us a carrying value of 7,680. That is the carrying value. You now compare this carrying value with the revalued amount. How much is the revalued amount as at 31st of December, 2023? You look at the note in the question paper. The examiner said, the property was subsequently revalued to 9,800 in December. To 9,800. But of the 9,800, the depreciable component accounted for 65%. The depreciable component of property is the building, and it was 65. So I now come here and I say, the revalued amount was 9,800, but of this, the building was 65%. So I have 98 times 65, which gives us 6,370. Okay, minus 7,680, we are getting it as 1,310. This time, it's a loss on revaluation because the revalued amount is lower than the net book value of the asset. So we now have a loss on revaluation. We have a loss on revaluation of 1,310. But remember, this loss is occurring on an asset that previously had a revaluation gain. The asset had a revaluation gain. Now it has a loss on revaluation. When such a situation arises, the loss should first reverse the earlier gain. And in case there is a balance, that balance is what we take to the profit or loss as an expense. So what we are saying here is that the loss on revaluation should first reverse the earlier revaluation gain. The earlier revaluation gain. and the balance should be recognized as expense in the profit or loss account as below. Now, previously, we have a gain of 1,200. That gain was taken to OCI. For me to reverse this gain, which is in OCI, this is the gain I'm referring to. This gain here. It is in OCI or valuation reserve. It is a credit. If I'm reversing it, I debit. So I'm going to come here and I debit revaluation reserve, stroke OCI with 1,2. I'm dealing with building only. I'll show you when it comes to land. Then I credit. The building. But before we go to crediting the building, look at these members. I have a loss of 1,300. And I have only reversed 1,200. That means I have a balance on the loss of 1,310 minus 1,200. That balance is how much? Is 110. 110. That balance of 110 is what someone would take to the profit or loss as an expense. But remember, land and buildings are considered as one asset called property. Since it is one asset, and I also have gains on revaluation of land, you see this gain of that on land, and this other gain of 900 on land again. So I still have enough gains on land. Therefore, I can still reverse some of those gains because land and buildings are one asset called property. So this reversal here was specific on buildings. But I can also reverse the loss on land, on buildings from land, because land and buildings is one asset. So I also debit revaluation reserve, specifically the one on land. How much is left to reverse? 110. Then I now pass the entire credit to land and buildings. And because I'm combining the two assets, I say you credit property with 1,310. In this property, I am crediting the building as well as reducing part of it from land. Okay? Because land and buildings are one asset called property. So when I cannot say that I have gain on land and I have a loss on buildings. Since it is one asset, we net off. So here we have advised on accounting treatment. Okay? Note number 3. It says, Moore commenced a project to develop a new system that would be used to manage fixed assets and minimize errors that arise from manual interventions. The software is expected to have service potential of 5 years. Service potential is the same as useful life. The company incurred $152 million on research and feasibility study to obtain new knowledge about the project. In addition, the company incurred monthly costs of $175 million to develop the software starting 1st of March 2023, but could not demonstrate the technical feasibility and the intention of completing the project until 1st of August. MORU has capitalized all project costs as development expenditure, and its company policy to charge amortization expenses to cost of sales. So colleagues, what we see from here, the examiner is testing us on IS 38 intangible assets. Specifically, they are testing us on development expenditure. When do you capitalize development expenditure? When do you expense? We know from IS 38 that research costs should be expensed, regardless of the English. Because at research stage, it is known, you are not certain that you are going to implement research findings. Many entities have done research and have not implemented research findings. So research costs must be expensed. But development costs should be capitalized. But for you to capitalize them, there are conditions. Those 5 conditions stated in the standard. You capitalize if you can demonstrate your intention to complete. If you can demonstrate the technical feasibility of completing the development of the asset. If the cost of the asset can be reliably measured. If you can demonstrate how the asset will generate benefits to you. Those conditions. Now, in this question, they said, we incurred research of this, that we shall expense. Then, we incurred monthly costs. Monthly, every month, we incurred 175 million. Starting March. So we incurred 175 in March, April, May, June, and July. So between March to July, we could not demonstrate the technical feasibility. If you cannot demonstrate the technical feasibility, and you cannot demonstrate the intention of completing a project, the costs that you have incurred during that period should be expensed. Remember, under IS 38, for you to capitalize development expenditure, you should comply with all of those 5 conditions under IS 38. Intention to complete, feasibility, technical feasibility of completing, how the asset will generate benefits, how you will be able to measure the cost of the assets, etc. So therefore, this is how we can address this. So you come here and say that this is note number 3. And note number 3 is about a software. Note number 3 is about a software. As usual, you start by quoting the standard. So you say that the transaction should be accounted for using IS 38. IS 38 is called intangible assets, as below. Should be accounted for using IS 38 intangible assets as below. You start with research costs. How do you deal with research costs? These must be expensed. We don't capitalize research costs. We expense them. Okay? So, how much is research? The examiner said we incurred 152.5 on research. That we expense. But what the accountant had done was to capitalize everything. Indeed, when you go to the trial balance, you'll find there an item called development expenditure. That development expenditure there. The accountant had accounted for everything as part of the cost of the asset. So we are going to expense research. Because it is already included in here, we are going to credit this development expenditure and then debit profit or loss. So for me to pass those entries, I come here and I say debit our profit or loss. Research is normally put here under admin unless guided otherwise. My research cost is to the tune of how much? I'm expensing 152.5 million. And then I'm crediting our development expenditure. Development expenditure by 152.5. Okay. Okay. Development expenditure is an intangible asset. We are saying research shouldn't be capitalized, it should be expensed. That's why we pass these entries to reverse what the accountant did. After this, I now come and account for development costs. You now come and account for development costs, development expenditure. They told me that the monthly cost is 175 million. That is the monthly cost. But between 1st of March up to 31st of July, I couldn't demonstrate the intention to complete, and I couldn't demonstrate the technical feasibility. Therefore, the costs incurred during this period should be expensed. Costs to be expensed. Because during that period, I was not complying with the conditions under IS38. So how much was incurred during this period? Remember, every month you are incurring 175 million times how many months are in between here? You count from March, April, May, June, and July. So in between there are 5 months. This gives us 175 times 5, which is 875 million. That cost should be expensed. How do I expense? I debit my profit or loss account, specifically admin, with 875, and I credit my development expenditure. Development expenditure, that is an intangible asset that we are crediting. We are saying this cost shouldn't be capitalized because we are not complying with all the conditions under IS38. Then, whatever is incurred after 1st of August should be capitalized. But look at this. How much did we report? The accountant reported 1552. Over the 1552, there is a research of 152.5. Then there is a development expenditure of 875, the one we have expensed. When I add these two, I come to 10 to 7.5. This is what I have expensed. Therefore, how much remains? 1552.5 minus what has been expensed will remain with 525. 525 is the correct development expenditure. Okay? Colleagues, we are saying here that the correct development expenditure capitalize equals the 1552 equals 1552.5 million minus research, which is 152.5, minus the development expenditure that we are expensing, which is 875. When you subtract, you come to 525 million. Okay, that is what we should capitalize. The examiner went ahead to say that, okay, Mulu had capitalized the whole expenditure. Good. So we have seen how much should have been capitalized. Only 525. That is what should have been capitalized. We have dealt with that note. The same note says that the company charges amortization expenses to cost of sales. But we do not know when the project was completed. Because you don't know when the project was completed, because you don't know when it was completed, you cannot calculate amortization expense. Otherwise, if we did, then we would calculate amortization expense and also pass that entry. Okay? We continue with note number 4. Note number 4 says, in order to expand production and meet increasing demands, Mura acquired a modern production machine at 5.4. This was on 1st of July 2023 from Germany. 40% of the machine was financed by a grant from government. Mura is yet to account for this transaction in its financial statements, although their policy provides for depreciation of such assets at 20%. Okay? That becomes note 4. I come here and I say, I have note number 4, and note number 4 is about production machinery. Production machine. Production machine. Colleagues, we have 2 standards at play here. We have IS 16 because we are dealing with the machine, and we have IS 20 because we are dealing with government grants. So you say that the transaction should be accounted for using IS 16. Already you defined IS 16 up, and IS 20. IS 20. IS 20 is called government grants. Government grants and a disclosure of government assistance. Government grants and a disclosure of government assistance. As below. Okay, as below. Let us see. They said, we bought a machine at a cost of 5.4 billion. That is the cost of the machine. But government gave us a grant to the tune of 40%. So 40% of 5.4. That gives us a grant of how much? 5.4 times 40%, which is 2160. That is the grant we got from government. The examiner said, we did not account for this transaction at all. Therefore, can we account for it? Initially, since you did not account for this transaction at all, you will start from initial recognition. Initially, you would debit PPE, specifically production machine, because you acquired an asset at cost, which is 5.4. Then you credit. How did you finance this asset? I used the government grant. So government grant initially should be recognized as deferred income. So I credit my deferred grant. How much was deferred grant? 260. It means the balance I paid using cash or bank. How much is balance? 5,400 minus the grant. So I have a balance of 3,240. Those are the initial entries that the accountant had to report. Then subsequently, the accountant had to depreciate the assets. So the accountant should charge depreciation expense. They say the policy of the company is to depreciate at 20%. So you have 20% times the cost of the asset. The cost of the asset is 5.4. So 0.2 times 5.4, which gives us 1080. But this is depreciation per annum. That is per annum. But colleagues, we see the asset was bought on 1st of July, 2023. And we are reporting 31st December, 2023. So this asset has been with us for only 6 months. So you time apportion this by 6 out of 12. So if I time apportion by 6 out of 12, I come to 540 as my depreciation expense. If that is our depreciation expense, then you pass the entries. You debit your profit or loss, specifically admin expenses with the 540, and then you credit the asset. The asset is PPE. If you want to be more clear, this is a production machine with the 540. I have passed the journal entries for depreciation. Then I now go and deal with the grant. How do I deal with the deferred grant? Deferred grant. Deferred grant. When you get a government grant, initially, you treat it as a deferred income if you're using the income approach. Of course, there are two approaches under IAS 20. You can use income approach, you can use direct approach. Specifically here, we have assumed that the company uses income approach, which is the common approach. 99% common. So this deferred grant that you treated as deferred grant initially should subsequently be realized. Should be realized or amortized. You realize over the life of the asset. The life of the asset that was financed. The life of our asset is 5 years. Where are we getting 5 years? Is it because the depreciation expense is at 20%. Because the depreciation is at 20%, that means each year 20% goes off. So for the asset to be fully depreciated, it should be depreciated over 5 years. So when I'm realizing this grant, I can use useful life or I can use depreciation rate. That means the income, the grant realized each year, becomes, you get the depreciation rate, which is 20%, times the amount of the deferred of the grant. The grant that was deferred is 2160. Okay, so I multiply this by 2160. What does it give us? So 0.2 times 2160, which gives us 432. That is grant realized every year. But the grant came to me on 1st July. And that's when I bought the asset. And we are reporting 31st December. It means for only 6 months, my realized grant becomes 432 times 6 out of 12. So I have 432 times 6 out of 12, which is 216. That is the income I should report this year. If this is the income, I pass my journal entries. I debit. Whenever you are realizing a grant, you reduce the deferred grant and recognize the income. So I debit deferred grant to reduce it. Deferred grant with how much? 216. And then I credit my profit or loss. Grant is treated as other income. So you shall take it to other income. And don't confuse other income with other comprehensive income. Other income is immediately after gross profit. Okay? Here, I have also advised. Initially, defer the grant, subsequently, amortize it over the life of the asset. Okay? Note number 5. Note number 5 says, the inventory in the trial balance is stated at cost. 10% of this inventory was found to be obsolete. And because it is obsolete, it could be sold at 20% below its cost. While 50% of the remaining inventory has a high turnover with estimated selling price of 2% above cost and associated disposal costs of 5% of the expected selling price. So this note is about inventory, and it calls us to look at IS2, which is inventory. So I will come here and I say that note number 5 is about inventory. Inventory. Then we quote our standards. We say that the inventory should be accounted for using IS2 dash inventory as below. What does the standard require us to do? The standard requires us to value inventory at the lower of its cost and the net realizable value. You compare its cost and NRV, and that's what we take. Now, how much is the cost of inventory? The cost of inventory. This is coming from the trial balance. When you look at our trial balance, the cost of our inventory from the TB is given here. Inventory is here. It is 4.5. That is the cost of the inventory, 4.5. We come and report here. Of the 4.5, they have said we have obsolete stock. Obsolete stock. Equal to how much? They say the inventory and the trial balance is at cost. 10% was found to be obsolete. So 10% of 4.5, which gives us 450. That 450 is obsolete. But the examiner has said this could be sold at 20% below its cost. That this obsolete inventory, whereas it is obsolete, we can still sell it. But when we sell it, we are going to get proceeds which are 20% below its cost. I want us to first stop here to where there is cost. So that means the NRV of this stock, the NRV of obsolete stock, we are selling at 20% below the cost. That means we are selling at 80% of the cost of that stock, the 450, giving us 80% of 450, which is 360. Colleagues, you now look at these two things. You have stock that we are valuing at 450, yet its NRV is 360. That means our inventory should be written down. It requires a write down. You get 450 minus 350, giving you 90. We can only realize 360, yet for us, we are valuing it at 450. So we are overstating our stock. The 90 is overstatement of inventory. Because my inventory is overstated, I have to write it down. How do I write it down? I debit my profit or loss account. Because if inventory is written down, that write down is recognized as an expense. In the profit or loss account, inventory is part of the cost of sales. That's where you put inventory. So I'm debiting this specifically cost of sales with 90, and then I credit my inventory with 90. Okay? So I have dealt with obsolete stock. Then I now continue. They again say that on top of the 10%, there is also 50% of the remaining inventory. 50% of remaining, that means I have to first calculate the remaining inventory, then I get 50% of that inventory, and I deal with it. Okay? I come here, and I say that what was the remaining cost of inventory? Remaining cost of inventory. The remaining cost equals the total cost minus the cost of obsolete inventory. Our total cost, remember, was 45. The cost of obsolete was 450. Therefore, the remaining inventory after removing obsolete stock was 4,050. Now, of the 450, of the 4050, the examiner is telling us that 50% of that one has an issue. So I now get 50% of 4050, which gives us 2025. This one we have to deal with it. What is he saying? Go back to the question. He's saying that 50% of the remaining inventory has a high turnover and it can be sold at 2% above its cost. But we shall incur 5% of the selling price. So it tells us that we have to calculate NRV for this stock. So the NRV for this stock becomes, remember NRV is net realizable value. You get the selling price minus the cost to sell. They say it can be sold at 2% above its cost. Its cost is 20.25. So if I'm selling at 2% above cost, it means I'm selling at 102%. That will give us the selling price. Minus, we shall incur cost to sell equivalent to 5% of the selling price. So let us go slow. First, calculate the selling price. So you have 20.25 times 102 divided by 100, which gives us 20,065.5. That is the selling price of that inventory. However, for us to sell at that price, we shall incur costs to sell equivalent to 5% of the selling price. So 5% would give us 0.3. Therefore, the net realizable value of this inventory becomes the selling price minus the cost to sell, giving us 2065.5 minus 103.3, which is 1962.2. You see? So this second category has a cost of, look at the cost. Its cost is 20.25, but its NRV is 1962. IS2 requires us to value stock at the lower of its cost or NRV. So that means even this second category requires a write down. It is also overstated because we are stating it at 2025, yet we can realize only 19. So I have overstatement of inventory. Overstatement of the inventory. This equals 2025 minus 1962.2, giving me minus 2025, which is 62.8. That's an overstatement of inventory. Because the inventory is overstated, I report that as an expense. I debit our profit or loss, specifically inventory is under cost of sales with 62.8, and then I credit our inventory. I credit our inventory to write it down by 62.8. Okay? That is note number 5. We continue. Note number 6. Note number 6 says that Moore offers 3 months warranty on all goods sold to customers. During the quarter ended December 2023, the company sold 50,000 components, all of which qualify for warranties. Moore expects 10% will need minor repairs at a cost of 5,000 per component. 6% will require major repairs at a cost of 7,500, while the remaining components will have no defects. The examiner is testing us on IS 37 provisions and contingencies. So we can say this note number 6 is about sale of components with warranties. Note 6 is the sale of goods, but with warranties. We are selling goods, but with warranties. They say, how much were the total sales? So the sales units were 50,000. Of this, they said, there are those that will require minor repair. They will have minor defects, and they will require minor repair. And those are 10%. And the cost of each minor repair is 5,000 per repair. There are those that will require major repairs, and these they have said they are 6%, and the cost of the major repair is 7,500 per repair. The balance will have no defects. Because there are no defects, there will be no what? No repair. And these are equal to, when you get 10% plus 6%, that gives you 16%. So I get 100% minus 16%, that gives me 84%. So 84% of our sales will not require repairs. You get it? So therefore, we say that the transaction, remember always to quote the standard, okay? The sales transaction should be accounted for using IAS 37. IAS 37 is what we call provisions. That standard is called provisions, comma, contingent liabilities, and contingent assets as below. Okay? As below. So I'll come here and say that the cost of minor repair equals, they said minor repairs will be 10% of the units sold, and we sold 50,000 units, times the cost of minor repair, which they said is 5,000. What does that give us? 10% of 50,000 times 5,000, giving us 25 million. Then the cost of a major repair is, they said major repair will be 6% of the 50,000 of the cost per major repair, giving us 0.6, 50,000 times 75, which gives us 22.5 million. So overall, the total cost of my repairs will be 47.5 million. This is the total cost. But customers have not yet returned these goods. They haven't returned these components. Because they haven't returned these components, I have also not incurred this cost. But I expect to incur it Therefore, in that case, we book a provision for the expected costs. Okay? We shall come here and say debit provisions, profit or loss. Provisions are expenses. Because they are expenses, they go through profit or loss. So I'm debiting profit or loss. Why am I debiting profit or loss? Because I'm creating provisions. But maybe to make it a little bit clearer, we are saying that the expected cost of repairs creates a future cash outflow. Cash outflow. Hence, requiring provisions. Requiring provisions now. I expect to pay in the future. I expect to incur costs to repair these assets. Therefore, I have to create a provision now. So I debit our profit or loss account. Provisions, best practice is to charge them to admin. I'm going to charge them to admin costs of 47.5, and then we credit the provisional liability, what you call the warranty provisions. You have given warranties, therefore you have created the liability on your balance sheet. That is how you advise on that transaction. Okay? We continue with the same note. It continues that in addition, Muru was sued by environmental pressure group in the region for breach of environmental regulations. The pressure group is seeking compensation of 250 million for bringing such a matter of public interest to the concerned authorities. The evidence available indicates that previous similar cases have been resolved in the affirmative. That means if a case is resolved in the affirmative, it means it is resolved in favor of the what? Of the plaintiff, the one who sued. If A sues B and the case is resolved in the affirmative, it means it has been resolved in favor of A, the one who sued, the one who went to court. So cases indicate, evidence indicates that such cases have been resolved in favor of the one who sued. In this case, it is the environmental group that sued us. And we now estimate that the unrecoverable legal costs would be 40 million. Even if you win the case, there are costs that you cannot recover. The legal fees. The lawyers must be paid, regardless of whether you have won the case or you have lost it. What can change is how much they get paid, depending on how they have structured the agreement. So colleagues, in this note here, they are telling us that we are going to lose the case because evidence indicates that companies that have already sued, cases have been resolved in favor of those who have sued. We were taken to court because we violated environmental regulations. So, again, when you look at this legal suit, we are saying that the probability of cash outflow is more likely than not, since previous similar cases previous similar cases have been resolved in favor of environmental pressure groups. That is what the question is saying. Environmental pressure groups have won similar cases. Therefore, hence, provisions should be recognized. Provisions for both compensation and unrecoverable legal costs and unrecoverable legal costs should be recognized. Should be recognized. Good. How do you recognize provisions? We shall come here and debit. Provisions are expenses and liabilities. So we shall debit our profit or loss, specifically admin. With how much? The group is claiming 250 million, whereas the unrecoverable legal costs are 40 million. So in total, it is 290 million that we should provide for. And then we shall credit the provisional liability, the legal provisions, with 290. You credit the legal provisions because chances are high that you're going to lose the case based on the evidence available. Next, our next note is note 7. Note 7 says, Moore purchased goods on credit from Weshire, a foreign supplier, for $80,000 on 30th of September 2023. On the same date, Moore sold goods to a foreign customer for $100,000. The foreign customer settled the dollar invoice, but the amount payable was still outstanding. Moore has not accounted for the effects of foreign exchange fluctuation in the trial balance, and the foreign exchange rates are relevant. IS 21 is a very, very, very critical standard. Effects of changes in foreign exchange rates. So we shall come here and say, we have note 7. And note 7 is about a forex. These are forex transactions. Because we have a sale as well as a purchase. So we shall say that the transaction, there are two transactions. So the transactions should be accounted for using IS 21. IS 21 is called effects of changes in foreign exchange rates as below. As below. They said Moore purchased goods on credit from Weshire. Because we bought on credit, we have a payable. And that payable is worth $80,000. And the examiner said that by reporting date, we hadn't paid. And we did not account for this transaction. What we did not account for are the effects of foreign exchange fluctuations. So initially, how much was this payable? Initially, what does the standard require? The standard requires initially to translate at spot rate. Initially, you translate at spot rate. Therefore, because I'm translating at spot rate, the amount of the purchase was 80,000 times the exchange rate in September, because this transaction happened on 30th September, that exchange rate is 37. Okay? So I multiply this by 37. This gives us shillings. So you have 80 times 37, giving you shillings to 96 million. That was initially. Then, subsequently, what did you do? Payables are monetary items. Payables are monetary items. Because they are monetary items, IAS 21 requires us to translate them at closing rate. So translate at closing rate. You have to refer to those rules of IAS 21. Initially, spot rate. Subsequently, closing rate if you are dealing with a monetary item. Subsequently, historical rate if you are dealing with non-monetary item, which is measured at historical cost. Subsequently, you can use the exchange rate ruling at the date of the most recent fair valuation, if that asset is measured at fair value. So, but payables are monetary, therefore, subsequently, we translate using closing rate. So, therefore, our payables become, remember, my payable is 80,000 times the closing rate is the rate at reporting date. Our reporting date is 31st of December, 2023, and it is 3,800. So I multiply this by 3,800. What does this give us? 80,000 times 3,800, which is shillings 304 million. So colleagues, you can see, if I'm to pay today, I pay 304 million. But if I was to pay immediately, I would have paid 296. Because I delayed the payment, there is an increase in the amount payable. That increase in the amount payable is what you call a forex loss. What I'm to pay today has increased. Therefore, I have what you call unrealized forex loss. Forex loss equal to 304 million minus 296 million. So the unrealized forex loss becomes 8 million. This loss is unrealized because I'm not paying, I'm simply translating a balance. But because the loss is on a monetary item, that loss will go through the profit or loss. So you debit your profit or loss. Specifically, I'm translating a payable. This payable relates to purchases. Therefore, I can charge this under cost of sales. Because it is under cost of sales, that's where we put purchases. And then I credit the payable. My payables are increasing because if I am to pay today, I would pay 304 instead of paying 296. But instead of going through all of this, you can summarize it this way, that the unrealized forex loss, equals the payable of 80,000 times the movement in exchange rates. The exchange rate is now 3.8, but initially it was 3.7. When you do it that way, you get a loss of 80 million. You can summarize it that way. Okay? So that is the payable. Then I now deal with the receivable. Remember they said, I also sold goods on credit for $100,000 what? Dollars. Again, initially, the standard says translate at spot rate. Translate at spot rate. Therefore, my receivable initially becomes $100,000 times the spot rate I sold on 30th September. This would give me shillings 370 million initially. Then subsequently, the exchange rate has changed. Therefore, because the exchange rate has changed, what I receive also changes. They say the foreign customer settled the dollar invoice. That means we received the money. The foreign customer paid us, but they paid us on 31st of what? Of December. So on 31st of December, how much did we receive? So you come here and say that on 31st of December 2023, what you received was equal to $100,000 they paid you when the exchange rate was now 3,800. So in effect, they paid you 380. By the time the customer paid us, the exchange rate had increased to 380. I now compare this and this. You can see if we had received this money in September, we would have received 370. But because we received it in December, we received 380. So there is a realized here, the customer paid. I'm not translating a mere balance. The customer paid. So therefore, the gain here was actually realized. So you call that the realized forex gain equal to 380 minus 370, giving us 10 million. Because that gain was realized, I pass these entries. I debit our receivables, because by the time they paid me, our receivables should have increased by 10, from 370 to 380. And then I credit, it is a gain, so it goes to profit or loss. It goes to profit or loss as the other income. With how much? 10 million. Okay, it goes to add. That's why you put forex gains. So, colleagues, that was the question. To advise management for an accounting treatment of notes 1 to 7. And we have adequately answered the question. So, for this and more, we encourage you to join us at Matabakas. To our students, to our candidates who are sitting the exams in December, we wish you success. We believe all of these sessions have shed more light. As question 1, any question that requires you to apply standards, approach those questions with confidence. Just stick to the principles of the standard. What does the standard require? And work out that question in line with the principles of the standard. Okay? I wish to stop here. For members who haven't joined us, we are welcoming you. Anytime, feel free to join Matapakas. For now, I wish you success in your December exams and hope to see you again next year when we meet now in advanced financial reporting. I remain your tutor, CPA Zed Muyingo. Have a blessed day.